Hi, everyone. Welcome back to the Mortgage Sales Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today we're going to break down 4 more articles in and around real estate. Today, guys, we got Federal Reserve holds interest rate steady, sets the stage for cuts, what that means for you and your money from CNBC. We got the CoreLogic S&P Case-Shiller Index, which suggests a pivot ahead, up by 5.1% annually in November, coming in from CoreLogic. We got the House passing a bipartisan tax legislation for low-income housing. That's from HousingWire. And then we have homebuyer incentive programs that rose nearly 2,300 in 2023. Now, it's not actually 2,300 in 2023. It's 2,300. So it actually rose by 804 programs. Now brings it to approximately 2,300.
Gotcha.
So a little bit of a communication there up the top about HousingWire. Thank you for the great article. So we're going to jump right in today, guys. First article at the top, Federal Reserve holds interest rates steady and sets the stage for cuts. What this means for your money. Okay, so you guys already saw this by this point. The Fed held steady rates at the end of its 2-day meeting last Wednesday, which would have been January 31st, the end of the month. Oh my gosh, the month is already, the first month of the year is already done. Which sets the stage for rate cuts. Now, here's what we're going to talk about up top, though, is, we were talking before about how many rate cuts we think it's going to happen. Some people last year were saying, they're setting the stage in December for 5 to 6 rate cuts. I'm like, that's going to be freaking every meeting. Not going to happen. And then some people say, they should do it twice. And some people, they shouldn't do it at all. So this is coming out and saying we should probably see 3. I mean, do you agree with this? Should it be 3 only? I mean, we were just talking in the last show about they'll probably start one in April. Now that's up for grabs, and maybe that won't happen. I mean, what do you guys make of this?
So I think, and I got asked this the other day, after the Fed came up, they were like, so why didn't they make a decision? And I feel it's because of data that still needs to be unpacked from last year. And then moving into this year, having a full quarter of data, moving into the new year, like we spoke about last time in our podcast, I think that would give them, enough information to really dictate what the direction of, monetary policy needs to be going into the new year. And I believe that's, what they're going to be doing as they come into the next meeting, saying, hey, this is the direction we're going to move. They might not cut or take a decision, but they might say what they're looking to do as they progress forward. Yeah,
everything that's just intended with the Fed, I mean, I like the way they just kind of give some type of anticipation. It just gets everybody to anticipate what's going to happen. But obviously, a lot of people are already predicting that we would already seen a rate cut already by this point, by this meeting. It didn't happen.
Yeah, no,
it didn't happen.
No, and it's not going to happen right out the gate. I think you're right. I think one of your smart friends told you at the last show. Yeah, someone who's on this show with you guys said that we're going to probably wait for the first quarter the data to come out, and I think it just will. I think that they have to wait because there's a part of this where doing something too soon will nullify their credibility, or at least dent their credibility if they have any left. Oh, watch the comments go off right now. The Fed, what are you talking about credibility in the Fed? There's no credibility at all.
But it goes against, I think everybody has their opinion mixed in this as well. So you hear a whole bunch of headlines. I would refrain from that and focus on the data.
And I understand. So let's talk about the data, because what some people consider the data is going to be the economic stuff. And some people say what they tell you, and the dot plot chart, like the blue chart with those little dots where all the Fed members project what they think it should be by the end of 24 into 25. So then based on the projections, the analysts go, that means they're going to have 5 or 6 rate cuts or 3 or 4 or whatever. Those are still predictions. It's not the data. But they are telling you that there's some division even among the Fed members of what they are going to do and when. Now, by the way, for you who are new to the show and you don't understand what the Fed rate is, this is the rate at which banks borrow money from each other overnight. So it's very short-term lending. But that precedent and that sentiment does bleed into all sorts of lending, different parts of lending, and changes what rates look like for car loans, credit cards,
everything,
line of credits, and then weighs in on mortgages ultimately.
Basically, for my my Gen Z people, based on the vibe the Fed is feeling, we'll understand how the outlook's going to be.
They had a pretty mid
Gen Z advocate.
They had a pretty mid meeting this month.
Facts.
Yeah, I mean, we got to see prior to the rate hikes, the banks were borrowing money at 0% from the Fed.
Right, for a long time.
The Fed funds rate was 0.
Yeah, 0 to 0.25%, like free money.
Yeah.
Free money.
You know, and so that's why we saw the low interest rate environment.
Yeah. And then one of the things the article does say is interest rates took the elevator going up. They did. They spiked it up real quick. But they're going to take the stairs coming down. And I think this is very, very well said. And it puts, perspective into what everybody's saying. They're going to rate hike. They're going to rate hike. They're going to rate cut.
Yeah.
But if you start cutting too soon, then we go right back to where we were at in the beginning. So all the progress that we made would then digress and nothing would really get accomplished. Back to the same thing.
There's a little bit of the damned if you do, damned if you don't, right? That's kind of the game. It's always this teeter-totter. And it's been that way forever. But the interesting thing you just brought up, though, is that, interest rates were held artificially low for so long.
I think he was barely born when that
You're
happened.
eventually going to pay the consequence for that. It's like, the term, the chickens have to come home to roost. Like, this is that. Like, we're going to have to basically pay the price for a little bit of time here while this, mellows out. And we're going to have problems. There's going to be continued inflation. There's going to be reinflation. Watch for that word. If you haven't been hearing the word reinflation yet, look for that here in the month of February. You're going to start hearing reinflation. And just like in 2023, the quote of the year for housing and real estate was date the rate, marry the home. This is going to be 2024's quote. I'm going to call it right now. Blast me in the comments if I'm wrong later. But this is going to be the quote of 2024, which is what Brian just said. Interest rates took the elevator going up, and they're going to take the stairs coming down.
Yeah. And this is despite them even knowing that 60% of the American households are actually living paycheck to paycheck.
And I think it's higher than that. I think it could be higher than that.
But come on, we got to
look at the
numbers. And it's still, that's still 60% is a lot.
That's a lot. Yeah, think about 6 out of every 10 people you talk to are going paycheck to paycheck. That's extremely difficult. 10
out of your neighbors that you go and they're probably saying, no, everything's great. Yeah, right.
And you know what sucks and puts a damper on all this? That on paper, it looks like, everything's good, the economy's growing. But in reality, people are suffering at home. Prices aren't deflating fast enough. And, just goes to show that people are still not making it out of the woods yet.
No, it's true. But again, they're borrowing now, paying later with the same mindset and mentality that we had before, and it was working, right?
Correct.
That's not working right now. We're still at the highest consumer debt there's been ever, right? We see Amazon's, and that's what people don't realize. Amazon came with a huge profit.
Yeah.
Yep.
Right after the holidays, And so those things, then you got Meta. Like you have all these things that are just showing like on paper, we made a ton of money.
Yeah. And you're going to see more layoffs because they're happening anyways. There's always like courses of layoffs. There's always seasonal layoffs, but you're going to start seeing more layoffs partly because of the economic pressure on companies, partly because of the high cost of companies operating run costs due to the debt that they're carrying and the Fed funds rate. That's like this top, moving up to the different levels of those conversations. But you're also seeing like things as simple or as complicated as like AI and technology that helps helps do things faster, quicker, or more accurate, or more whatever, with more volume. Pick your topic.
Efficient without paying hourly fee.
Well, right. And people cost money. Like that's the bottom line. True. But I think this is what when you're talking about the 60% of households that are living paycheck to paycheck, like this is the evidence that like the problem you cause over here shows up somewhere else. So if you like suppress something over here, it'll pop up over there. If something pops up over here, you got to suppress it over there.
Yeah. And then, although they said, with rates cuts on the horizon, consumers will see some of their borrowing costs come down. And that makes sense. But you can't, just go over the fact that they racked up all this debt. Well,
it's come down. But here, let me give you an example. Like, let's say you had a 15% card that went up to 30 and it returns to 25. Okay, so it went from 30% to 25. Yeah. Like, does that help somebody? So probably not.
I have a question. So if you had the option to pay anywhere between 16 to 21% on your debt, or anywhere between 6 to 7%, which one will you take?
I'm taking the lowest, 6.
I feel like you're baking in a refinance.
And here's the other thing too, is that other debt at 20. And if you go above the credit limit, if people don't read the little fine print,
boom.
But that's it. It's like they already broke their agreement.
Now
with
you're
the credit
on a
card.
whole different level.
Total different.
That's right.
Interest rate. So you could be even at a 32.
And then I'm going to bring it back to that. So people that are going through a financial distress situation right now, they probably, if they own a house, probably have a sub 3% rate. But because of the fact that their mind is so stuck on this low rate emotionally a huge emotional, they're not seeing the opportunity of being able to move this debt over here, consolidate it over here. And I'm not saying everybody should do this and go call me for a refinance. I'm just trying to break down the importance of, hey, you're paying this much on this debt over here that is variable, moving up and down, and you can't do anything about it until no, you can't do anything about it.
Yeah, in all fairness,
but if you bring it into your mortgage, now you have, free cash flow. Your debt then consolidated to a lower rate,
and it's a tax write-off.
And it's a tax write-off.
Right.
You still have that credit limit to be able to use, but now you consolidated that into a better, easy payment.
One word.
Consolidation.
Leverage.
Leverage. Consolidation. Something else.
Which one?
No, but
word.
in all fairness, though, I'm glad you mentioned that because this is not for everybody, and not every situation mathematically.
Definitely
will
not
work
trying
out.
to push him.
So look, there are situations where that's going to work out, guys. Like, we're in the business of doing this, so like it does make sense. And a lot of times, and last year we had several episodes where you guys delivered on show evidence of real case studies where you save someone. $1,200 when you'd save $1,300.
Yeah, it was
$575 was like another one. And it's like, okay, that actually represents real change for somebody, but it's not gonna matter for everybody. They may not qualify or whatever the reason is. But I think the takeaway here is that you have to step away from the emotional part of that decision and go, what aids me moving forward in the decisions I'm trying to make for my life and the milestones I'm trying to hit? How can I get there? And what do I have to do today in order to get there along the way? That I think is what the big takeaway is from that part.
Yeah, and it goes with everything. I just feel it's more on the consumer's habits more than, what's happening with the economy, because we can't control the economy and how that's going to, take.
But they're linked. But they're linked because when milk was $4 last year and it's $8 now, not a real example, but if it changes overnight like that and I still have to buy milk or eggs or whatever, that's not just me like flippantly spending money unnecessarily. That's like me buying the things I have to buy. So it is part economy and it's part behavior. To me, they go together.
And I guess I meant it in a certain subject, like when you're buying a house. If you got to pay for gas, energy, bills, like regardless, you have to pay for that. But now if you're looking at it from an investment point of view where it's like, well, should I make that move right now or should I not make the move? I think that it's more about having the right information and not really falling behind on, past experiences or anybody else's experiences. But one thing that our guest said on the podcast that we recorded before this was that regardless of what people want to do, they're going to want to find the solution that fits their problem.
Yes.
And once they find out and they know what steps they need to take into doing that, it opens up more of a confidence for them to take those steps without having to be like, damn, I don't know if I should do this. This is going to like pan out the wrong way. So.
Yeah, no, that's a good point. And to kind of round out this part of this conversation, like the Fed eventually making rate cuts, everybody watching, is going to affect auto loans. It will affect credit cards. It is going to affect other things that, as a consumer, you are paying for or connected to. Now, on the other side, like, I know I had kind of barked out, it's probably more than 60%. It might be more than 60%. That might be 60% that are admitting it.
That's what I'm saying. There's people that are silently suffering.
It could be 60% that are admitting it. But,
it's so true.
The whole credit card situation, auto loan situation, there's only so much you can take. And we've, in the mortgage space, talked about October 2023 ad nauseum. And when rates hit 8%, that was like the hand touching the fire on the stove. And whoop, we immediately went, nope, we don't like that. Yeah. No one liked that. The market didn't like that. And the consumers didn't like that. And so I think you're seeing the same thing here.
Yeah.
It's gonna happen. We cannot have people get out of their financial problems while also holding 30% APR rates on their credit cards.
There's no chance.
Well, hey, guys, the good thing is that last year, the income levels went up by 19%. 19 cents. I'm sorry, 19 cents.
I'm like, 19%?
What? Yeah, the average hourly wage was $34.55, Andy. And
it went up like
we got 19 cents. Good. So that's going to take care of any inflation issue. And I think if you multiply that, you multiply that by 40 hours a week, 52 weeks in the year.
Heck yeah, you
it
can
was
buy
like
eggs.
71,000 and change.
Yeah, you're still talking
that's
about
still like the nationwide
average take home.
The average, come on now.
It is, we're still going to be circling the wagons around this affordability issue. The one thing I want to make sure that I bring up specifically here is Doug Duncan, one of our friends, Doug Duncan, who is the chief economist at Fannie Mae, and he was talking about that he doesn't see affordability problem solved until supply increases substantially, interest rates come down, and real income rise. So he's talking three major variables have to all move in concert for this to work out. So the affordability will get solved with an increase of supply, interest rates coming down. He's saying probably dip below 6%, and then also real income rises. So it's a combination of all these things.
Which one of these do you guys see actually happening, though?
Well, I think. Well, we had talked about supply in the last show, and we made our predictions.
Yeah.
I think supply is going to show up because people are going to have it show up. I think selling their home is going to be some people's way out of their problems financially.
100%.
If refinance doesn't work, they're going to sell. Okay. I think interest rates coming down is going to be a byproduct of being election year here, number one. Fed reducing interest rates, number two, especially if they're going to do 3 rate cuts, even if there's 4. And then real income rising. I think for the people who have jobs, it will rise. Subtext. I think you're going to have a lot more unemployment this year.
For those that keep their jobs, they might get a raise.
But here's
lots of layoffs.
Here's why, and I don't know where this is being talked about yet. So if you're watching this segment of the show, and you can put a comment in with a link, I think that what's going to happen is the people that are going to have continuity of their employment are going to get raises substantially because it's going to be necessary to keep good employees. Number one. Number two, they're going to have to pay for all the bills. And number three, the talent you have to keep, you have to pay.
Yeah.
Because you can't AI everything.
Yeah.
You cannot AI unplugging your shower drain. Someone's going to have to come and do that.
Yeah.
You can't AI your oil change. So my point is there's a lot of jobs still out there where there's a person that has to do something for the outcome to happen.
We need welders.
And I think there will be real income rise. I don't know if as long as it can outpace inflation, I think we're going to be fine. But if it does not outpace inflation, then we're in trouble. Lastly, for me, guys, is on this, I want to talk about the savings rate really quick because there is a substantial... is substantial the right word? To me, it's notable. Let's use notable. I think it's notable that you can still get a CD now that outpaces inflation.
Yeah.
Because that was not the case for a long time.
Ever.
I mean, money market, we're like less than 1% return for a 12-month commitment, $100,000 minimum, or even $50,000 minimum. But now because of the Fed increasing rates as fast as they did since March of 22, those yields have been in great favor for people who've parked money.
Right.
Correct.
And that means to me, if you have the money and you can park it for 6 months, 9 months, 12 months, and it's going to outpace inflation, do it.
Yeah. Well, here's the thing. You don't even have to go that far and put in a CD where it's just you're going to have to put it there for a certain amount of time, right? Now, a savings account, you go to SoFi or whatever, you could just Google APY, annual percentage yield. They're paying like 5.5%, 6%. Before, they weren't doing that because people were just giving the bank a problem by putting all their savings in there.
Right.
Now the banks are like, wait a minute, people aren't saving. And we're one of the worst countries to save money.
Yeah.
Right?
Economy.
But how do I encourage people to still come and deposit money?
Give the money.
Well, I got to give them a bigger
Gotta have a
annual
return.
percentage yield, right? And so I'm going to entice them by giving them 5.5% or 6%. And now I'm starting to see more of that in the last, it's been a few months now that we've seen that happen. But
that's going to carry out
crazy.
through 2024 because even if the Fed cuts rates and they do 0.25% rate cuts, let's say there's 3 of them. Okay, well, that's still going to be a return on your money being parked that's higher than inflation, or it's even higher than the inflation projection, I think. So I think that's still going to be good for people. So if there's any positive about this rate cut part of what's happening in 2024, you're still going to be able to get a good return on your money if you park it.
We'll see. I mean, we'll see, right? Once that starts going down too and the banks are borrowing money for less, let's see if they want to pass that on to the consumer because a lot of times they don't.
That should be your token takeaway. We'll see.
We'll see.
William, no, we'll see. We'll see.
You know?
Not just doubting Andy, but we'll see.
Correct.
We'll see.
I don't doubt it. It's just...
We'll see.
We'll see.
Okay, guys, we have to talk about the home price index. So, I love data. You guys all know that. I love Altos Research. I love CoreLogic. So today I brought with me U.S. CoreLogic S&P Case-Shiller Index suggests pivot ahead up by 5.1% annually in November. This is a look back. So we're in the rearview mirror here, and we're talking about the home price index and the increase of home price averages, also by region and also some select cities, San Diego, named in the article. So,
it's just crazy.
Here's the thing. I know, and I understand, again, we've had to address this before on the show. People go, the housing is going to crash. There's going to be a collapse. Everything's falling apart. There are certainly reasons why I would get behind that argument if it were not for people still buying homes. And individuals buying homes, married couples, and private hedge funds, and cash buyers, and people that we know that are investors buying multifamily units because they're like, I'm scooping up as much, because they're playing a market share game, not a... the system's going to fail game.
And
because the system fails for everybody, even all the big dollar players that are in the arena too, and they don't want that, do they?
It does.
Okay.
And I mean, hey, we have all these DIY, we have Selling Sunset, we have all these things, we have social media. There's so many people out there just buying, and they're finding creative ways how to get stuff done. So
and even
I don't know.
Even for the people that, let's say, that got squeezed out because of the market, doesn't mean that they don't want to buy.
Correct.
They just can't at the moment. But that want to buy, is still there. And once the level playing field comes back down,
FOMO.
So
there it is.
what this brings us, guys, is that we have already in 2024, we have more new listings relative to the same time last year. And we've talked about this. This brings home buyers off the sidelines. Rates have been lower than they were in the fall. That's also helping. Now, the inventory is going to be an issue, but I think that's going to come back to people needing to sell, not just wanting to sell. So the pent-up buyer demand is probably going to get absorbed a little bit by some of those the shadow inventory, or let's say delayed inventory that is on its way. It's just not here yet. So I think the spring buying season is going to be really good. One of the actual data points I wanted to share was that as of November, the index rose by 5.1% year over year since November of 22. So basically from November of 2022 to November of 2023, this is the average across the country, even in places that have negative and some that are super 5.1%.
Wow.
So
do the math on that. That's crazy.
In the first segment of the show, we're talking about certificate of deposits with a 5% return. Now we're talking about real estate that if you bought in November of 2022, then you compare it to November of 2023, you're at 5.1%. Yeah. Now, in some places, that's a lot higher in certain parts of the country. When you look at the 10-city and the 20-city composite indexes, they posted the fifth month of annual increases in November, up by 6.2% and 5.4% respectively. Yep. And both indexes are also up by 7.5% and 7% respectively since the beginning of 2023.
And this is nationwide.
This is nationwide. This includes the places that are struggling still.
Which is crazy.
Places that are struggling are weighing this number down. And the places that are above it are like well above it. Yeah. We're not talking 5. We're talking like 10.
West Coast, baby.
Yeah, West Coast not mentioned. The first one is Detroit at 10%, but okay.
Isn't that crazy?
But later on in the article, we get the West Coast.
Yes, but again, all statistics and all math are need to be purviewed and looked at from the window of time measured. Yeah. So are we measuring Detroit from that same time? Yeah, okay, well, it had a glut. So now it's up 10%. San Diego up by 9.9%.
9.9.
Chicago up 8.8%.
Chi-Town, Chirac.
Here's the thing that the article brought up, and I want there to be some interaction here. Compared with the 2006 peak, the 10-city composite index is now 47% higher, while the 20-city composite is up by 54%.
Crazy.
Nationally, home prices are 16% higher, adjusted for inflation, compared with 2006. Here's the question. Back in 2006, at the peak of 2006, who was yelling, buy now? And who was yelling, this is insane, no one should buy a house?
Michael Burry.
Michael Burry.
Damn. Sorry, guys. Hey, just for context.
Joining us for the Mortgage Show. See you next week.
Hey, just for context, as soon as you asked a question and said in 2006, I just said Michael Burry.
That's it.
No. Well, I wasn't even born.
Watch the movie.
Why do you think I'm asking this question? Why do you think I'm asking this question about 2006 and the quote-unquote peak of 2006? Why am I asking that?
Andy?
Well, you have a lot of people saying the same thing right now, don't you? Yeah. People are saying you should be buying now because it's only going to go higher. Correct. And you see some people like, I would never buy now. This is insane. Why at that rate? Why at that price? The same stuff was being argued back in 2006. And where do we find ourselves? 47% higher in one composite and 54% higher in the other.
Wow.
I said other, not the other, but the other.
We got him. We got one on him.
Jesus.
So, look, it's really hard to look at these things and then I'm not gonna say
and not be able to compare. You
have
can,
compassion.
Right?
It's not a lack of compassion. It's like, how much are you willing to die on the hill for the math not working out in your favor?
Yeah.
And there's just so much of this. I see that it kind of becomes like it's old. It's like, man, this is so old.
Well, I mean, we saw December. As soon as rates kind of started coming down by 1%, we saw oh my goodness, it was pretty crazy. And obviously, you always start off the new year with a little bit of like, okay, I don't got time for that right now. We're kind of doing things, right?
Yeah, but look how many escrows are open right now.
Yeah,
you have
exactly
a lot of escrows open right now. You had, I'm going to say it, you had 7 new leads on Monday alone. Yeah. Right? Okay, so are we going to...
People are coming out.
Are we going to ignore that and just pretend like the phone isn't ringing and the emails aren't coming in?
No, and I'll be honest, because there was months where it wasn't like that.
It's already last year, exactly.
There was months where there wasn't like that, and all of a sudden from one day, literally feels like one day to another... And everybody tells me the same thing. I was waiting. I wanted to see how things are going. I wanted to see what the next year was looking like. And people saw that things aren't budging. Houses aren't dropping. There is no houses. So it's like, is now or, I have to wait until something does happen. Yeah. But then we go back to...
Yeah, right now this is
46%.
This is something we just I got a text this morning that I actually received from an offer that we submitted. it started at $799. We went all the way to $830. Okay, $830,000. We had a seller multiple counter offer, and then the seller multiple counter offer came back and said, close 29 days. They give us enough days. The person is actually buying a new construction, and then it says seller to remain on property 59 days 59. At $1 a month.
Oh wow.
So obviously some people have to take possession on the 60th day. Correct. So they were very clever with it. But that means we're paying top of market. Hopefully the value comes in.
That's 5% higher than the list price.
And then if your payment's like $5,000 and change, right? That's another $10,000 and guess what? We lost our offer even though we still agreed to those terms.
Oh, you didn't get it?
What?
Nope.
Oh,
somebody came in higher than that. They'll probably offer longer, freer stay. Maybe they offered with not even $1 pay.
$1 a month? 50 cents.
50 cents. We'll do you one better.
But those are
we'll
two packs.
Pay you to stay in the house.
Yeah. And those are the things that are happening right now.
No, but I mean, just so that people get context of that, that's how competitive it still is here in San Diego.
Yeah.
Yeah, no, it is, and I mean that makes this number even more hard to digest because when you look at San Diego having a 9.9% increase in as one of the members of this 10 and 20 city composite. That's because of this.
Yeah.
That's the result of the activity that you're talking about right now is people outbidding each other, coming to the table. They can afford it now where, 800 was my cap. Nope. Now it's 840. Oh, nope. Now it's 850. Now it's 875 or whatever. Yeah. They got the cash to pay the difference if that's the case on the down payment, if they needed one, or to cover whatever the appraisal won't match on value. And, This is one of those areas where this is just what's happening.
Yeah.
I can't tell
it's
you it's
confusing,
not.
to be honest. I was a little confused. I didn't think I was going to see those days again. That was something in 2020, 21, where we're seeing a lot of that, right?
Yeah.
And so I'm like, 59 free again?
But this is that demand. This goes
Correct.
back to what they're talking about is like the pent-up demand. It has to get absorbed somehow. Yeah. And so when inventory shows up, this is what it's going to look like. And until there's more inventory than there is demand, the prices are going to continue to be bid up because people can afford to do it. And and I know that part of it is I was waiting. Part of it is people were sick and tired. Part of it is what I know I'm hearing people say. It's like, I want to get my piece of this. I just want to play Hungry Hippos and get some of the market share. Because right now I have none of the market share, and I really don't like that. Yeah. So if I'm going to be paying out my ass for a rent at $5,000 a month, might as well be paying it for a mortgage on a house I own or something like that. You know what I mean?
Yep.
And in this case, actually, it was a father buying a home for the daughter. He has a big company in Mexico, and he's just like, I have to, have some tax write-offs here in the U.S., so let me buy my daughter an investment where she can go in there, and because she's not making enough money to qualify, so dad has to step in, which is crazy.
And that's the thing where when we talk about friends and mortgage shares with Sophia, our episode with her talking about estate planning and looking at legacy, like that's the play. Like, okay, cool, maybe your adult kid can't pay for it now, but you can. You've had some success. Congratulations. Do what you want. Now, doing that and being, let's say, wise about it creates that family legacy that you can pass on. I didn't know that was a story.
Yeah,
I didn't know that was what was behind that.
Correct.
Wow. That's amazing.
That's cool.
Yeah.
I think that's really neat. That's super. That's just super encouraging.
We're actually starting to see a lot more parents step in and helping their children being a co-borrower and stuff like that because they understand the affordability issue.
Yeah,
and it's funny you brought that up because I had a client too that I was telling you about earlier that I connected with, and he's like, "Hey, I'm looking to buy for my son and my daughter-in-law," and then he's like, I want to help them out because I just don't see it benefiting them throwing their rent, to the trash. Yeah. Then he said, then my other two daughters, I would love for them to buy a house as well, and I want to help them out. So, a lot of that is happening, and the parents are seeing, hey, this isn't making sense. These aren't looking good. I'd rather you be secure, have a payment that, you can ease into. Yeah. I could help, and then we'll figure it out down the line.
Yep.
Wow, that's crazy. That's crazy. Well. Overall, in general, of the 20 city composite, only one city had a negative or had a decline in value, and that was Portland, Oregon, and it was by 0.7%. So it's less than 1%. Wow. I mean, it's almost statistically negligible at that point. But for the 20 city composite to be all positive except for that one, and that one so negligible, not that big a deal.
Some people don't like rain.
On the map.
They don't like rain. the rain, among other things. Home prices are up 45% nationally since March of 2020, and San Diego's up 55%. So again, San Diego outpacing the rest of the pack, even from that measurement. So,
Jesus Christ.
Yeah, house prices are going to continue going up until the people saying it's all going to crash and burn are finally right.
Yeah.
So you're saying there's a chance?
Yeah, so you're telling me there's a chance. All right, guys, we're going to move to Housing Wire. This is, as House passes bipartisan tax legislation, lawmakers feel pressure from voters on housing. A bipartisan tax bill passed by the House would expand the low-income housing tax credit, but its odds in the Senate are uncertain. So this is a bill for what the acronym is LIHTC, Low Income Housing Tax Credit, being lauded by the MBA, Mortgage Bankers Association, and the NHC, National Housing Conference. But there's some of the observers are saying the odds are that it passes is very low and uncertain, but it doesn't make the problem go away.
No.
That's what I was going to say. And that was a huge part of my argument that,
Go ahead and bring it.
For me, reading this, I think to myself, well, what can the law really do to make things more affordable and make people have more money in their pockets? I'm sure they could do something, right? But do you really think giving a tax credit is going to help you afford more?
No, it's not about the affordability on the front side. It's about overall the incentive to do it.
So, okay.
But here's the problem. It goes upstream.
Is it incentive or is it affordability?
Hold on. It goes upstream. It doesn't even, you have to go before that. It comes to the builders.
Yeah.
This literally says the legislation should make a difference in the construction of affordable housing. That means upstream, the builders got to be on board.
Yeah.
So they have to have some sort of let's say, not security, but feel confident that, well, you want us to build more homes because we have a housing shortage? Cool. How can you help us? Because people can't afford it. So you want me to go and build something that people can't buy? No. Okay, so come up with a way that if I build it, they will come, right? Field the dreams. I will build these homes, these apartment complexes or whatever, and if you can incent the people that cannot afford or maybe on the fringe of affording it to get in, now we're both getting what we need. You need more housing from us. Yeah. We need more security that's going to work out if we stick our neck out
because
there.
Already as investors, when you're building affordable housing, they already get a tax credit already right off the bat.
Right.
So the benefit has to be now even extended further than that to make it really exactly.
Yeah,
exactly.
Now, this particular bill it estimates that there could be a $200,000 additional units over the next 2 years. That's actually a lot in a very short amount of time. Still doesn't necessarily alleviate our whole demand problem, but go ahead. Go for it.
This was my other thought when I was reading this. How beneficial is it that they're doing
it?
How beneficial and convenient is that they're doing this on election year?
Yeah.
Huh. Hello. Sounds like a vote snag to me.
But then
we've been having this problem for years now.
Okay, so if you're saying it is that, then why are they also saying it's going to have a hard time passing? Wouldn't they just pass it if it were for that reason, though?
Well, because
following your rationale.
But they're taking that and saying the Democrat side isn't going to pass it. The Republican side wants to pass it, but then it goes back to you say, I say, you say, I say. Well, what about the people? It doesn't matter, but
come on now.
Because my thing is why wouldn't they pass it if this is going to help everybody? Because it won't benefit this. And I'm asking, I'm not making a point. Is it because it's not going to benefit both parties? How it should.
I don't know that it will. I think that's part of your. I think that's part of your point, and that's also part of the problem. Is it may benefit one side versus the other more than.
And
the
I'm
other.
just spitting because
But again, yes. I mean, are the people the fodder? In some cases, yes, they are, and it sucks to say that. But is that the truth? Sometimes, yes, it is. I mean, look, I'm going to tell you guys live on the show. There was, a comment last week I had to respond to where I had to give some additional context what we're talking about.
Yeah.
And it's like, oh, look at all these dudes with privilege, kicking the straw man. It's like, no, that's not it at all. We were talking about the active duty military couple whose combined BAH housing allowance was $7,600.
Yeah.
And I'm not saying you got to go out there and make $200,000 or you can go kick rocks. I'm saying that here in San Diego, if you're married and your spouse is making $4,200 of housing allowance and you're making $3,400, your combined housing allowance is $7,600. Yeah. So by no means are we just going to, sitting on some throne of cash talking down to people that can't. This is important.
Yeah.
But this is only going to be as important as the people that have to pass it, and they're going to want all their accolades. Wow. That is the way it goes.
I was just going to give a shout out to her because, I told him, wow, must be nice. I made the comment to, people getting the BH. He's like, must be nice. He looked at me, well, you had the exact same opportunity to join at 18.
That's true. That's true. And some people did.
Kudos. I'm going to just shut up.
And then you go back to our conversation with Lloyd Stanford, Mortgage Heroes, Friends of Mortgage Heroes episode 2. He's talking about. I said, what would you? I think you or me asked him, what would you do different if you had to do this all again? He's, I would have bought a place sooner and bought more of them because he and his wife
everywhere I was stationed.
Yeah, everywhere he was stationed, he sold 4 homes. So it's again, I get how the context can be misconstrued if you're not watching the whole show or the whole segment. Sorry, but at the same time, these things are what we need. We do have to have solutions for housing where there's shortages, and it's going to have to take both sides to come a little closer together.
Yeah. That's right.
Yeah, so the builders having a little bit more, let's say, confidence, or let's say actual tactical solution for people to get in is going to help.
Tactical. That's what I like.
I thought it was good that the crisis of affordability is drawing more attention in Congress.
Yeah.
Because, this was not going to be something they try to tackle in 2020 or 2021. Like, it was not the hot topic.
Yeah.
Something else was. And that's just what it was. But, there seems to be a lot of support for this. There's going to be some blowback because there always is. And it's like schoolyard fighting.
Again, let's just see if it passes.
Yeah.
Let's see.
I understand it seems narrow, but there's a reason that this is important. There's a very distinct reason this is important, and it actually has to do with our next article. So, you guys, this is our next article. Then actually, I know they're unrelated, but related somewhat, and I'll get to why I say that.
Yeah.
Because, also in from Housing Wire, we have homebuyer assistance programs rose to nearly 2,300 in 2023. 3 in 4 available homeownership programs were tied to down payment and closing cost assistance.
Yes.
I want to say right at the top of this section of the show that the increase of programs was actually 804 new programs that are designed to assist with the purchase of a manufactured home. And that takes us up to 2,300 total available programs. So the article is a little bit, could use a little massaging.
Yeah, there you go.
But I thought it was very interesting that the, I'm sorry, I already said that wrong. I'm sorry, you guys. Let me go back and say this. A total of 135 new homebuyer assistance programs were introduced in 2023. The 804 I keep talking about, that is for manufactured homes. So
yeah, I was kind of like,
I'm sorry.
That is skewed there.
I want to make sure it's okay. It's all right. Let's make sure that's clear at the top. But,
thanks, Andy.
So we're finally at this number where we have 2,300 available programs, but 75% of them, 74 specifically, are down payment and closing cost assistance.
That's crazy.
So is that even prevalent right now for us in San Diego? Is that working here in San Diego? Where do you see it working? Why isn't it working? Why should it be working and it isn't? Give me the goods.
Well, we already know CalFHA already has that, right?
Yes.
And they only provide you with a certain amount of funds that are available.
Well, yeah, it's a bucket, and when the money's gone, the money's gone.
And it's gone quick.
Yes, sir.
And they have participation on your equity if you sell at a later time.
Yeah.
You know?
And then this time around, they're actually making it even more difficult. You have a voucher, you have a time period, and you have to use it if not, basically. And it's a round robin. You don't just get it. You have to send your application and be chosen.
Yeah.
So it's a little
so
bit more.
There's different ways how to do that. But here's the thing. Here's a challenging thing in San Diego. I'm not saying that because you're going with down payment assistance, that's gonna, your offer won't get accepted. What's happening is when you're putting a down payment assistance, purchase agreement versus a conventional or something that's going to close quicker, the other type of financing options have the tendency of closing faster.
That's true.
Okay?
Yes.
With down payment assistance, you have to get everything fully underwritten, clear to close. Then you send it to the next stage for the other underwriter, CalFHA. They underwrite that and say, yep, you're good to go.
Right.
Okay? That could take 45 days.
Right.
And people are like,
wait a minute. You're outside a normal time frame of 21 days or 30 days.
Exactly. So all those have tendencies to kind of get in the way and skew the way a first-time home buyer is going to look at the property.
So you think is the timing the biggest issue, or is the timing the perception that if I have buyer A who doesn't need this and buyer B who does, buyer A might be more strong? Is that part of it too?
Well, if you're put in the seller seat and you look at you're comparing, right? You're probably going to go take the path of less resistance. Mm-hmm. Who's going to close faster? Who's going to give me the proof that's already done?
Yeah,
it could be done faster. And I just think that if I'm representing the seller, I'm gonna coach them that this is probably the best option if you want to get to that next stage of where you're looking to be at. Because remember, all these times make a difference for some people. Some people already have to be in their certain destination if they have work orders, or they have to close at a certain time because they have another home that they have to purchase. So in real estate, everything's about time. So
what is your professional advice to someone who is maybe looking at down payment assistance and knowing that there's these potential issues or things that can prevent them from getting their offer accepted? What would you tell them? What do you say to people?
It's very difficult because obviously it's very challenging in our end. But I would tell somebody like this, hey, maybe we're gonna have to just take a look at a property that's been maybe sitting in the market a little longer.
Oh, that's a good point. Okay. That's a good solution.
Because
Because they've already been waiting.
The seller's already waiting, so we already see that they don't, they don't have to be somewhere that quick. So maybe we could put them in there.
Yeah.
And let's put an offer on that. So I don't know, little things like that could make a difference.
Okay.
Because what we don't want to do is discourage somebody either.
Yeah, and
of course not.
They already took the time to get approved for a down payment assistance program. Like, how do we help them out?
Well, that's what I'm saying. There's a fine line between like not being honest and being discouraging. But it's like sometimes the honesty is just discouraging. Yeah. So sometimes it just is that. It's not about whether you're going to tell the truth or not. It's like, hey, the reality is this. You might not like that.
Yeah.
But that's the way it might be perceived.
Well, it was like the first wave, right? When the CalFHA came out last year with it. And they allotted, what was it, like 500?
So 350 million. And
then 500 million. Then went down to 400. And then it's like, we didn't know. But those funds were gone within 30 days or less. It was done.
Yeah.
Like it was done. Like
which demonstrates the need for it though. Like it kind of like proves the point. Oh, we need all this money to do this for people because of this and that and the other thing. Well, yeah, that kind of proves the point. If that money evaporates like that fast, that proves a point. And I remember last year we talked about it in the spring, I think in 23. I was saying watch for creativity in the market. When things are tight like this, people start getting creative. It's local agencies, it's municipalities, and then even in this article, you see a growing number of non-bank mortgage lenders recently rolled out down payment assistance programs to increase their origination share in challenging mortgage environments. Other lenders that have introduced DPA programs or down payment assistance-oriented programs: Rocket Mortgage, United Wholesale Mortgage, Guild Mortgage, Guaranteed Rate. Like these are household name kind of mortgage companies.
Yeah,
like you got your UWM, right? It's 1% down. But the point is that they're doing it. There's a county loan limit. There's a limit, not a county loan, but there's a limit to that.
Yeah.
Right? Which I believe is 350 where
that's not anywhere around here.
We're going to get here in San Diego.
Yeah, but other parts of the country that might be like very lucrative for someone to take advantage of that. Number one. Number two, I think it proves the point that the agencies or even in this case banks, non-banks, they're going to get involved because if you see that creativity is required to get even more market share and to get a large database of clients and make more money, you're going to start doing stuff like this. Otherwise, you're going to find yourself on the outside looking in while your competitors do stuff like this.
And I think these things are great. It just helps people inspire and encourage them that, hey, you know what, there's hope. Well, how do I get to this? And how do I do that? I mean, obviously they launched these programs because they're going to work.
Well, a couple weeks ago, Brian and I were talking about how there's some school districts that are actually participating in housing now too, because the amount of allocation they have from tax funds to pay teachers for public school is inadequate for the teachers to actually live in the place where they're being asked to come teach. And so one of the things is like, well, the school district's like, well, we need to buy this place or rehab that place and provide housing for teachers and educators because our allocation of tax funds to pay them already absorbs everything we have to pay them with, but that pay isn't still enough. We can't give them more money that we don't have.
Wow.
So the way to offset that was for them to come up with some creative housing solutions and provide housing for teachers.
Not bad.
I think for like the younger generation and people that I spoke to that, are interested in down payment assistance, I think one word comes to mind, Will.
What's that?
Leverage.
Yeah.
And the reason I say that is because it goes back to the points that we made earlier about the buying habits of younger generations. I feel that if a younger, buyer is like, hey, we can give you 20% down and you can keep your $40K that you have in the bank, but you could use ours, the younger generation is going to be like, heck yeah, I'll take the $100K. And I feel it's a program for people that do need it, and it does work when you need it. But I have had clients that make well over 6 figures, and programs have now increased as well the income limits for these programs.
Income limits,
I have clients that are like, great credit score, great profile, but they're still like, hey, if the assistance is there for first time per program, I want to have it and I want to use it.
Yeah.
And they're like, oh well, I do tell them it's gonna take longer. Some of them are like, all right, that's fine.
Yeah.
So I think it really just goes on case by case. If you don't need it, don't get it. Because it does come with stipulations down the line. Like we have a client right now selling a house. He thought he was gonna, be free and clear and not have to pay that debt that he had for the down payment assistance. Turns out he has to go fork out the $22K that he got, but he didn't know that. So
but here's the thing.
And he didn't need it.
But here's the thing. You're kind of saying, in other words, you're saying, well, I've waited all this time and I've waited all this long. Why not? Might as well try it.
Absolutely.
Just like you're saying, hey, you got DPA. Go to a seller that's been sitting on the market. That seller, maybe they're on the market for 3 months, 4 months. Well, might as well take a look at that offer. I've been waiting all this time. So maybe there is a little marriage here in my hypothetical scenario on the show. But if you got buyers feeling that way, sellers feeling that way, maybe that's a match. I don't know.
it happens. The reason why they make these products because people do accept them.
Because they need it. And
some people do need them, and they do help some people.
Well, absolutely. It helps. It's leverage at its best. You know, if you can borrow money and no out-of-pocket cost, that's not a problem. I mean, we have a VA like that. It's almost like down payment assistance. Just doesn't require down payment. Right?
That's right.
The only difference is
you put your time in for it.
Yeah, the only difference is, you can close those things within 10 to 21 days versus the other options.
Yeah. Well, and the leverage point is key in this part too, guys, because I did not know until preparing for the show today that 686 of these programs are available for the purchase of a multifamily property.
Correct.
I did not know that. Every time I hear down payment assistance, I always think, oh yeah, that's for primary residence, primary, but also your own personal and only one. I was not aware that there were so many programs available for multifamily, which is great because then there's leverage and there's the investment opportunity possibility with that too. So that was a nice surprise for me to learn that in the prep for this.
Well, here's the other thing on the multi. Back in November 19th, I think they passed that new rule with Fannie and Freddie, 5% down. Mm-hmm. That was something we just never seen that.
Right.
And I know you've been talking about it, like the government or banking systems, they're going to become creative. We already see Rocket. We already saw Rocket. Gale Mortgage, United Wholesale, UWM, Guarantee Rate.
Big hitters.
They're doing it. Well, you see how even the school districts already thinking like, hey, how do we help our teachers?
Yeah. So you got banks, municipalities, you got school districts, you got all sorts of solutions coming to play.
Correct.
To try to give people housing that's affordable.
Let the people do what the people do.
Well, yeah,
capitalism.
That's true, but also there's still creativity required.
Totally.
This is evidence of that. Our last two articles, I think, are evidence of that. Obviously, at the legislative level, there have to be some solutions for bringing back some affordable housing.
Yeah,
part of that's market function, part of that's builders and legislation, and then I think down payment assistance. Again, I think that's part buyers and sellers. Yeah. Like, hey, we want this, and this is useful for us.
Yeah, the beauty of all of this is that at least we live in a state where we try to bring options.
Yeah.
I was listening to this other podcast in Canada. Their 30-year is a 10-year.
Yes. Oh, yeah. That's the one you shared. That's right.
And so they have adjustable rate mortgages, and their current rate right now at a 10% rate is like a little over 8% currently.
No, a 10%, a 10-year loan.
Yeah, 10-year loan is like 8%, correct.
Yes.
The 10-year, and then the 3-year is like at a 7.5%. Adjustable rate mortgage. Mm-hmm. So every 3 years they're refinancing over here. So we're a country that has a mortgage for 30 years.
Yeah.
And they're trying to bring, FHA to a 40-year. Imagine that.
Yeah. Yeah.
Because there's only a way to make it affordable, even though we look at it like, oh my God, 30 years is going to take me forever.
Yeah.
But it's going to be leverage. It's what it is. You know, it's
what
it is.
One word.
It's totally
Some people have 10. Yeah, one word. Some people 10 years are like, you know what that payment looks like at 8% right now? My goodness.
That's what I was like. Yes.
No, thank you.
Yeah.
I'll take none.
Well, it's still well, I thought I heard him say it was still amortized over 30, but it's a fixed for 10.
You know what? That's what I didn't know.
I think it was
Thank
fixed.
you, that thing.
No,
I missed that part.
It's adjustable by nature. It's basically a 10-1 arm. Think of like a 10-1
got
arm.
it. Okay.
So it's fixed for 10 years and it was adjustable after that. So here's the deal though. Let's say you get to the 10th year and the market's lower than 8. Fine, let it adjust downward.
Yeah, but what about you have a great rate at 2.7 for 30 years?
Well, but they don't have that. It's 8, you said. So
exactly. But what I'm saying is here with us.
Yes.
Right?
I know.
30 years, that's great.
It's the golden handcuffs he talked about, show after show after show.
GC.
People are locked into their low rate and they love it. So, and I love it for people too.
Yeah,
but
thanks for clarifying that.
It has created some new problems. So, thank you guys for another great show. What was your favorite part of the show today?
My favorite part is that at least we're starting to see a new bill trying to be passed so that we can help the less fortunate to try to get in there and give them some type of hope and encouragement that there's a possibility.
Yeah, so. I like that. Cool. How about you, Brian?
I think we've been doing a really good job of having our pulse on what's going to happen. We talked about things getting creative past episodes of more help in the market, more ways to get creative with helping affordability, and also with the decision of the feds. I think we've not figured them out because I don't think anybody has, but we kind of understand the way that they're moving, what they're doing, and I think the more that we follow it, the better that we'll get at giving people the news.
advice.
Well, I was going to say that the Federal Reserve was my favorite part of the show because I'm a big nerd. But I actually am going to say it's the CoreLogic Case-Shiller Home Price Index because I'm a big nerd. So same reason, but different choice. And here's why is because I like that the data doesn't have a team it plays for.
Yeah.
This is recorded information on county records that gets compiled into producing these quarterly reports or monthly reports, depending on which one we're looking at. So I like that because there's always going to be somebody who says, "Oh, but they're cooking the books and they're fudging the numbers." Okay, I'll take that explanation. I'll take that answer, but it wouldn't be by that much to generate a 5.1% annual increase of home prices.
Yeah.
You would have to do that hundreds of thousands of times incorrectly in your favor to generate that number, and that's not happening. So
No, I like that.
I'm not saying it's not happening. I'm just saying the amount of thumb on the scale you'd have to do to make that outcome is tremendous. So thank you guys.
Thank you. And one of the last things I'd like to thank our audience. Thank you so much for watching us. Thank you for liking us. It's been just great. So I'm actually now enjoying more of the journey too because of it, right? Like if we're giving back, and that's one thing we're very good at is always giving back without expecting anything. So thank you so much for always just keeping a pulse with us and for joining us and your comments. Thank you.
Yeah.
Good or bad, send them.
Absolutely.
Good or bad, send it. If you're new to the channel, we have another show we launch every week on Fridays called Friends of Mortgage Heroes, where we talk with and interview our friends in and around mortgage and real estate. Be sure to tune into Friends of Mortgage Heroes. And I've enjoyed doing this with you guys too. Those of you all watching, this is not our core job. Our job is not to sit here and talk about all this stuff. Our job is to actually do the stuff we're talking about.
We're in the trench.
Yeah, we're in the trenches, except for when we record this show. So thank you guys all for watching. We appreciate you doing that. Remember to like this video, subscribe to the channel, and turn on notifications so that you catch every episode right when it's launched. Thank you guys for a great show. Thank you all for watching.
Appreciate it.
And we'll see you again next week.
Bye, guys.
See ya.